Imagine this. The decisions you make today will have the greatest impact on your future self. Time is the greatest ally when it comes to investing. The earlier you start and the more disciplined you are, the more you can benefit from the magic of compounding. Today, we're going to dive into this incredible power of investing and compounding. Remember, time in the market is better than timing the market. Stick around, because in this video, I'm going to show you how to harness this incredible power of compounding to transform your financial future. Your future self is going to thank you for paying attention. First, let's start with the basics. What is compounding? Compounding is when your earnings are reinvested over time so they can earn money too. This can happen with interest or dividends. If you're using interest, it'll be called compound interest. And if you're using dividends or investment returns, it's called compound returns. Essentially, it's earning interest on interest, which can significantly accelerate the growth of your initial investment. Now, throughout this video, you'll hear me say interest or compound interest, but the same concept can be achieved with dividends. So wherever you hear me say interest or compound interest, in your mind, if you're interested in dividends, just think of compound dividends, same concept. Now, before we get into the nitty-gritty of what the numbers look like to explain the power of compounding, let's try and visualize this powerful force. So do me a favor, for a second here, close your eyes and imagine and visualize with me. Imagine it's a winter snowy day and you're on top of a hill. And in your hands, you grab some snow and you're making a snowball. And now you're pushing this little snowball down a hill. Now, as it rolls, the snowball picks up more snow, growing larger and larger. By the time it reaches the bottom of this hill, it's turned into a giant snowball boulder. This is the snowball effect, and it's a perfect analogy for how compounding works in investing. Small, consistent actions can lead to substantial results over time. Now let's take a real-world example to explain this concept. Suppose you invest 100 shares of a stock for $6,000, which is roughly $500 a month. And let's say this stock pays you a 5% dividend or a 5% yield. At the end of the year, you'll have roughly $500 of dividends. Now, if you reinvest those dividends to buy more shares, your investment grows over time. Over time, this compounding effect can lead to substantial growth in your portfolio. Now, trust me, this gets even better. Compounding can have a dramatic impact on your wealth creation over time. The longer the time horizon, the greater and the larger the impact you can have. So looking at this example again, if you're going to invest $500 each month for 30 years with a 5% annual return, you'll have roughly over $416,000 by the time you get to retirement. And of that amount, roughly $236,000 of that are earnings. Now, what happens if you were to adjust same concept, but start 10 years earlier? Look at the magic of compounding right here. If you start earlier and save for 40 years instead, same $500 each month, but for 40 years now, you're going to have over $760,000 by the time you get to retirement. And over $500,000 of that amount is pure earnings. You can clearly see this example, 10, 20, 30 years, how dramatic the ending balance is. And the only thing you're not changing how much you invest, which is $500 a month. You're achieving a very safe 5% yield. Now, keep in mind, the market over the long run averages around 7, 8, 9%. So I'm even using a conservative 5% estimate. So in this example, 10, 20, 30, 40 years, you're saving $500 a month, but the only difference is your time horizon. If you're saving for 10 years, that's $77,000. 20 years, that's $200,000. By the time you fast forward to 40 years, that's $763,000. So imagine if you weren't just doing $500 a month. What if it was $600 a month? Or what if for the first 10 years, maybe you did 500. Then as your earnings grew, you've increased that 500 to 600 to 700 in line with the earnings. Just imagine what this snapshot could look like 10, 20, 30, 40 years to your retirement. Dividend reinvestment is a prime example of the compounding impact in action. By taking dividends from your stocks, from your ETFs, from your REITs, whatever investments you have that pay dividends, you're not just saving, you're essentially buying more assets that generate even more dividends. And you keep doing this over and over again. And that really is the secret formula to building long-term wealth over time. Compounding at its finest is like rocket fuel for your portfolio. It lets you grow organically without having to make additional out-of-pocket investments. Investing is a marathon. It's not a sprint. It's the art of disciplined investing. And what is the cornerstone of this art that we're talking about? It's a deep understanding on how to unlock and harness the magic of compounding to work for you. Regular investing and regular reinvesting of those dividends is like planting seeds and watching your portfolio grow into a lush, beautiful forest. And then once that forest is in full bloom, you get to benefit from eating those fruits. If I had to give advice to my younger self when it comes to investing, my advice would be invest consistently, whether it's weekly, monthly, quarterly, yearly, doesn't really matter as long as you do it consistently, or better yet, invest regularly every time and each time you get paid. You can make it that simple. People and books make investing sound so much more complicated than it needs to be, especially if you're watching the news and those talking heads are talking about the stock market and the futures index and the composite index, ups and downs, derivatives, hedges, mutual funds. It's all way too complicated. To keep it simple, all you have to do is invest consistently. This not only harnesses the power of dollar cost averaging to your advantage, but also steadily compounds your gains over time. The key is automate your investments and make regular contributions effortless, without thinking, without the emotions. Set up an automatic contribution from your bank account to your brokerage account. When you do this, that regularity will also help to smooth out the ups and downs of the stock market. If you start on this investment journey as a disciplined investor, you're going to turn the tides of this market volatility to your benefit and to your favor. So far, we've been talking about how to take the power of compounding and harnessing it to fuel your portfolio growth, how to build wealth over the long run. But there's one crucial aspect of building wealth, and that is how to avoid lifestyle creep. Generally, people progress through their careers, people will make more money. The mistake happens is when people take those extra earnings and they start spending lavishly without that discipline we were just talking about, spending on luxury and flashy goods. But the problem isn't the spend on those luxury and flashy goods. By all means, if you're going to spend and it truly makes you happy and it's something you truly love, spend on it. Not the issue. The issue is spending extravagantly and it's buying you temporary happiness. People fall into that trap when it's temporary happiness. You keep spending to get that dopamine impact. You spend, you get a little bit of happiness. You spend more to keep that little bit of happiness going. The key is how to get long-term happiness out of your wealth. If you can live a modest lifestyle, resist that temptation to spend lavishly on unwanted things, this can have a significant impact on your wealth generation. It's not really a secret or a complicated formula. In order to invest and build wealth faster or invest more, you can either cut back on expenses, take those savings and invest them. Or you could increase your earnings and take that increase and put it in the market, put it towards your investments. That's really what it comes down to. While cutting on expenses has its limit, the side you should really be focusing on is the earning impact, the earning side of the equation, because your earnings, the sky is the limit when it comes to your earnings. Now, what do I mean by that? That could mean maybe you get that extra certification to help fast track your promotion at your job. That could mean maybe you start a side hustle. If it's a passive income generating side hustle, that's even better. Because what you're doing is taking those extra earnings and you're putting it in the market. You're putting it towards your investment to help that power of compounding work even better and faster. The key is to live a lifestyle that makes you happy. There's no point in cutting savings, not spending on things that truly make you happy, because then what's the point? You're just living a life for the sake of those dollars to invest. You want to make sure you are investing that's sustainable, but also living a lifestyle that is sustainable, that brings you true happiness, not those small little bits of happiness when you keep spending more and more just to get that little hit. What is it that truly makes you happy in the long run? Compounding, as we just talked about, is the magic of building wealth over time. It's a steady journey to building wealth over time. It's not a sprint. And if you can couple that with a lifestyle that makes you happy, you're going to be so much better off. And when it comes to personal finance, the typical advice is that as your income grows, take a portion, figure out what that portion is, spend it on yourself, what makes you happy, but also take a portion of that income increase and put it towards helping you build more wealth over time. And the secret of all this, the sooner you start, the earlier you can start, and the more you can start with, that snowball that we talked about is just going to roll faster and faster, and it's just going to get that much bigger by the time it gets to the bottom of the hill. Remember the old saying, the best time to plant a tree was 20 years ago. The second best time to plant that tree is now. Begin with any amount you're comfortable with. Whether it's $10, $100, doesn't really matter. Start with whatever you are comfortable with and expand that amount as your income grows. Small investments can blossom into significant gains if you give it just enough time to grow. So take that step today. Remain committed, stay disciplined, and more than anything, just be consistent. You're going to watch your financial garden thrive. The earlier you begin, the greater the harvest. And that's a wrap on the transformative power of investing early. Remember, it's that snowball effect that turns small, consistent investments into a mountain of wealth over time. Don't forget to check out the links in the description below for exclusive promotions and discounts and financial models that I've crafted for you to help guide you on your investing journey. These tools are designed to help you make informed decisions and grow your portfolio with confidence. And make sure you stay connected with my content on more insights like what we covered today. If you found value in what we talked about, make sure you like this video, you subscribe to the channel if you haven't already done so, and share this video with someone who you think can benefit from the power and magic of compounding. And if you're feeling generous, make sure you hit that thanks button down below to show your support. Your engagement truly helps me create more content to empower your financial future. Until next time, keep investing, keep growing, and let's build wealth together.